Why am I in my car talking about Japan today? Because the Japan bond auction just sent a warning shot to the rest of the world, and it could signal what's to come for the US and our interest rates. So Japan's 40-year bond absolutely flopped. Yes, it's 40 years. But investors barely showed up. The demand was at the lowest level in nearly a year, even with yields at like almost 3.5%. People still passed. Why? Because Japan's debt to GDP ratio is 260%. Inflation's rising, and the Bank of Japan is basically stuck. So to put it in perspective, a debt to GDP ratio means over 100% means that a country owes more in a year than the total value of the goods and services it produces. So just basically debt. Um, it's heavy reliance on borrowing, raising concerns about long-term stability and just rising interest rates costs because that's so much on debt. Every much they're in the hole just compounds. But this isn't just a Japan problem because it shakes the foundation of every government bond market, including ours. Because when investors say, I don't trust long-term debt, they're not just talking about Japan. So what opens up is our US debt to GDP ratio is 123%, and we're running at 6% deficits for years to come. So that's not sustainable. It's not 260, but here's what can happen. Our interest rates go up. The investors are going to demand higher yields because they're more risk, more return. That's going to push up mortgage rates, business loans, everything, which is kind of what I've been saying, something going on in those charts. But number two, we lose our buyers. If Japan and others offer better returns, money's going to leave the US and keep capital here. Also, Japan is a big buyer of our debt. So the US is going to have to offer even higher interest rates if we lose them as well. They're, I think, number two in who owns US debt. And then what happens is dollar weakness. If people stop trusting US debt, the dollar then drops, which we've seen. It's made a big move since. It's down, 13% or so for the year. That makes imports more expensive and could reignite inflation again. So I think at the beginning of the year, the dollar and the euro were almost even, pretty close to. Now it's, down to 87 cents. So any inflation is not going to be consumer-based spending. It's going to be all of these external things, which is the worst because we can't control them. We just have to deal with them. So I swear this isn't fear-mongering. I promise one day we're going to have all good news because this stuff is just math. But one major bond market stumbles and the ripple effects kind of go global. So we can't ignore it. And if we do, we risk like a slow motion debt crisis we can't handle at this moment. And stagflation. Our borrowing costs go up, our incomes are down, things cost more. And this is why the stuff you hear on the news is just garbage. It's never right. It's just delayed. We look at raw data, we look at the world around ourselves, and we make educated calculations. So that's why you're here. That's why I do this. And hopefully we all stay a step ahead. I will keep you posted. I have a new chart coming out soon. It's going to make you want to cry.